Hello, I'm Donald Leggett, and welcome to our latest London South East CEO interview. We're joined today by Maurice Healy, CEO of Glantus Holdings, a global supplier of automated accounts payable systems, who have just IPO'd in AIM under the ticker GLAN, that's G-L-A-N. Glantus raised gross proceeds of 10 million for the company and 4 million for shareholders at a placing price of 102 pence per share, giving them a market cap at flotation of 37 million. Greetings, Maurice. Congratulations on the IPO. Well done for raising all that money.
Thank you very much, Donald, and thank you for having me on.
It's a pleasure. So you must be pretty pleased, Maurice. It all seems to have gone swimmingly.
Yeah, I mean, it's fantastic. I mean, anyone who's gone through an IPO process knows how torturous it can be. So the last few weeks have been hectic, but it's wonderful. It's wonderful to be out the other side of it, and wonderful to be on the AIM market on the London Stock Exchange.
And would you describe it as a success?
Oh yeah, it was fantastic. We got a tremendous response from the investors on the roadshow, and we were twice oversubscribed at the end of it. And you know, it was an ambition we had. We've been dealing with Arden, who are our brokers, for 18 months. The pandemic came in between, obviously. So we had good time to build up a good rapport with everybody, to explain to everybody what our business was all about and how we were expanding. So it was good. And then to finally get to the end of that journey is just brilliant. For the entire team, you know, you do something like this, it involves everybody in the business, and it's been fantastic.
Great. So, which takes me neatly to Glantus, really. What are automated accounts payable systems, and what differentiates you in that marketplace?
Yeah, I always like to start by explaining the market and explaining what we mean by accounts payable, because a lot of people have this vision when you say accounts payable of a dusty finance office and somebody at a desk writing checks. Our version of accounts payable and the market we operate in, our customers are global organizations. So their spend in the US, when we talk about our customers in the US, it's $1 billion or more. In EMEA, maybe $500 million or more. And they've got suppliers numbering anything from 4,000 to 120,000. So large operation within these large organizations. And the problems that they face, the challenges that these accounts departments have, is that the scale of the organization means that they have multiple systems, multiple geographies, multiple versions, multiple currencies, instances of suppliers. And it's really difficult. Even with the most sophisticated systems, it's difficult to just get that holistic view of all of the data. And that leads to errors. And these are accounts payable departments, they lose millions every year through lost credit. So credit notes not processed, duplicate payments, contracts not being complied with, discounts not being applied, and it builds up.
So how do you make a difference then? How does Glantus and your automated system, how does it make a difference?
So our system, our platform, it's all our own IP, sits in the cloud. And it takes the data from all of these systems and these instances, and it brings it to one place where it's manageable. And we begin their journey by finding what they've already lost. So it's a discover and recover, get all the data, find what they've lost. Then we put in the automation so it doesn't happen again. And then we've got advanced analytics for them. So by doing the discover and recover first, we've actually given them an instantaneous return on investment. And then the other nice feature about our solution is that they don't have to change any systems. They don't have to retrain staff. They don't have to use, internal resources. It just fits across the piece. So it's a very elegant solution, doesn't risk operations, and gives them an instant return on their investment.
Okay, you operate globally. You've already talked about clients in the States and clients in Europe and beyond. 2 operating divisions. Talk us through that structure and how that has evolved. And you've nodded to the kinds of companies and sectors you operate in. Maybe a couple of examples of client companies would be helpful.
Yeah, no problem. So we currently operate in EMEA out of London, and in the States out of San Jose. There are markets. We have geographic expansion plans, and I can talk to you about that later. But right now it's EMEA and it's the States. And we don't have a sector specialism. That's not what we do. We work on their spend. Two questions, any organizations: how much do you spend? How many suppliers do you have? And then we're in. And we've got customers from Abbott, Diageo, Balfour Beatty, Aramark, Graybar, Tata, T-Mobile, Interflora, all of these global brands with this big turnover and large spend. And we're operating with them in all of their divisions. So we actually provide the service across 50 countries, even though we do our sales piece in EMEA and in the US.
That was a very good answer. You did well there. Now, every company needs an accounts payable system, I presume. So what's the size of the global market you're aiming at? Where's the growth going to come from? And will that growth be organic? Or given that you just raised a nice pot of money, will that also be through acquisition?
Yeah, so the market itself is huge. I mean, it's a 3 billion market, and it's a growing market. As economies grow, and we're coming out of the pandemic, then our piece of that market grows as well in the AP function. And the other thing that fuels our market is M&A activity. Because when you think about it, if one of our customers is acquired or acquires or is involved in a merger, then the issue I was saying earlier on about multiple systems, multiple geographies, well, that problem is compounded. So it's a growing market. It's a very exciting market, and it's attracting a lot of interest. And then with regards to our growth, we have three areas of growth, Donald. One is the organic. So organic, we have two parts to that. We have our existing customer base, and we have a lot more to do for those customers. So there's a lot of organic growth within the base at the moment. And then the brand, over the last 12 months has established itself really well in our market and in the US and in EMEA. And so we are getting a lot more, or organic new logo pipeline has doubled since the start of the year, purely, and a lot of it just inbound. I mean, we did a lot of virtual events and digital marketing, but it's really grown. So that's the first part, the organic. That's strong and exciting, and we will be investing part of the proceeds in that.
And in a funny way, that's the cheaper part of it, because that simply happens by itself.
Absolutely.
Easier,
we need more account managers and salespeople in different areas to maximize.
You just need to build the business a bit.
Yeah, exactly. The second part is the partnerships. I'd been a bit cynical about partnerships historically, because I don't want to be one widget of 12 widgets that some organization is selling. But we've actually got a very nice narrow focus now. So we partner with companies who are dealing with our profile of customer, but they're doing it in a narrow way. So we've partnered with a company that just works on utilities recovery, and another one that's on tax recovery. So and of course they need to expand their offering into their customers. And so we're an integral part of their strategic growth, and that works for us. And we've signed a couple of those earlier this year, and they're already producing revenues for us. So that's very exciting part. And when I was talking earlier about geographically moving on, partnerships is probably going to be a nice way for us to move into new geographies, a cheap way, a low risk way of us doing that. And finally, then our third leg to the stool is acquisitions. We're good at acquisitions. We know how to find them, we know how to negotiate them, and we know how to integrate them. In our most recent one, we brought a company that wasn't making any money. In the first 10 months that we had it, it contributed 700 grand to our bottom line. And that's at a run rate of 1.5 million in EBITDA. So we know exactly what we're doing with those acquisitions. So the combination of all of those three things, that's going to use up the funds that we've raised, but it's also going to fuel the growth. And this is all about scale for us now.
Great. Okay, who do you see as your competitors? Always an interesting question to ask. Is it niche specialists like yourself, or the big boys like Microsoft, tech giants?
Yeah, no, it can be any of those in different ways. So if you look at what I was saying earlier, there are three kind of parts of the journey we take them on: the discover and recover, the automation, and the analytics. And our competition tends to come from one or other of those areas. So, you know, a large organization, large AP function will go and say, oh, we need some analytics. So they'll talk to somebody who provides those analytics, and they'll talk to us. And for me, dashboards, don't tell my CTO this, but dashboards are the same now. They all have the same look and feel. Our guys would say ours are better. But generally speaking, if you're doing dashboards, they look the same. But what wins it for us is that when we sit down and talk to the customer, we present the solution in the context of the overall platform. So when they're looking at our solution, they're also looking at how we solve the bigger problem. And they recognize that problem because they all have that problem. And so we tend to win business against the competition on the basis of the context in which we present the solution.
Okay, financials, the dreaded financials. If you could talk us briefly through your financials and give us a sense of revenues in the States and here in the UK, and what's your funding look like? Look pretty healthy because you just raised money, all those kind of things. That would be very useful.
Yeah, so to the end of 2020, our revenues were around €9.5 million. That's recognized revenue. Now, we'd have a lot of deferred income because it's subscription revenue. 89% of our revenues are recurring revenues. And that's a big part of our growth strategy then, is how we're growing those recurring revenues, because our margins were 24-25% last year. They'll be over 30 or in and around the 30%, because the more we drive that subscription and transactional revenues up, obviously the margin increases because the cost of delivery doesn't increase at the same rate. So that's the strategy going forward. We're a very ambitious company, Donald. It's worth noting that management still own over 50% of this company going forward. And that was the very deliberate on our part. We are really excited about what's in front of us, because with the three legs I point out, the acquisitions, the partnerships, and the organic, we have a path, we have an eye line for what we're going to achieve over the next couple of years. You know, we've got a pipeline in all of those areas. And our ambition, what we're hoping to do as a management team, is to take the run rate this year up to around the $20 million from where it is, and to double that again next year by implementing across those things. Those are our ambitions. Clearly, that's our focus. That's our plan, because the multiples, and this is important for investors, I think, to understand. We want to be the best AP and all of that, but we know the multiples we can get in the States. We know that we can buy companies over here post synergies at 4 to 6 times EBITDA. We know when we hit scale, we'll get 18 to 30 times EBITDA in the States as a valuation, or 4 to 5 times revenue. So we're working those statistics very closely because we're doing it for ourselves as much as for our new investors coming in.
So you're aligned with investors. That's very useful. Let me just briefly ask you then, 2 years' time, what will the business look like in 2 years' time? And why should shareholders join the current shareholders and invest in you?
Yeah, I think the reason they should join us right now is, first of all, we've got a proven product, scalable product, and a proven market for that, and an exceptional client base. And out of that client base is coming 89% recurring sticky revenues. So at that pace, it's a good, solid company. But the main reason I think they should join us is that our ambition over that 2 years, and what you're looking at, is to get up to that 40-50 million turnover, and to get those multiples of 4 to 5 revenues, or 18 to 30 times EBITDA in the States, in the market over there. And we believe we can achieve that.
Okay, my final question, news flow. What can we expect to hear from you in the coming months?
We're going to be a busy company, Donald. We have a pipeline of activities, as I said, along those areas. We'd be hopeful that we'll have a lot of organic deals. We'll have some new partnerships coming online, hopefully, and potentially as well acquisitions. So it'll be busy and there will be news flow.
That was absolutely fascinating. I didn't know anything about you, Maurice. I know a whole lot more now. Thank you so much. You sound like an exceptional business. That was Maurice Healy, CEO at Glantus Holdings. You'll hear more from them in the future. To see more interviews like this one, please subscribe to the London South East YouTube channel. You can follow us on Twitter @London South East. As ever, thanks for watching. Please do stay safe.